AT&T recently released their earnings report for the quarter, and we can see the stock took a huge nosedive over the past 24 hours. It was down as much as 9% earlier, and it's currently trading at $18.92. Now, based off a quick glance at their earnings report, we can see they did beat their earnings per share expectations of 0.62 and reported 0.65, and they also beat their expected revenue. So what's the reasoning behind this huge decline in their share price? And it really boils down to one thing, and that is a new free cash flow outlook for AT&T. If we scroll down just a little bit, we can see they did revise their estimated free cash flow for the year to the $14 to $16 billion range. So because of this, we're going to be jumping into my stock valuation spreadsheet, and what we're going to be doing is we're going to build a few financial models to see if we can find the intrinsic value of AT&T based off of these new numbers that they have given us. So in this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model, and all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. But the first thing we're going to come up here and do is plug in AT&T stock ticker and hit enter, and you can see all this data is going to automatically load in. If we come over here and look at dividend data, we can see we're currently paying out $1.11 per share, which gives them a dividend yield of pretty close to 6%. Now we're currently looking at a 500-day chart, so we can see AT&T has been declining for quite some time now. 20, 50, and 200-day moving averages all down 10% over the past year, and past 2 years, 17.13%. Now analysts currently have a target price of $23.31. But let's go ahead and look into our stock valuations and see if we agree with that. And the first one we're going to look at is Graham's valuation. And this is a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors, and this is the formula he laid out for us to calculate intrinsic value. So the first thing we need is the earnings per share, which we can see we have listed right here for AT&T. It's the most recent earnings per share. We have the price to earnings of a company with no growth, which is 7, and now we're going to apply a growth rate projection. So for AT&T, a well-established, more mature value company that pays a high dividend yield, this is going to be a lower growth rate. Now they obviously had their spinoff with Warren Media in hopes that they could increase their growth rate, but for now we are projecting just 3 for their growth rate. Now moving forward, we're looking at an average yield of AAA corporate bonds of 4.4. So we're going to multiply all of this on top together. Once we have that, we're going to divide it by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it's currently sitting at 4.08. When we put all this together, we can see we come to an intrinsic value of $25.50 per share, which is higher than the current price. But let's go ahead and jump over to our discounted cash flow model. Now this discounted cash flow model is going to be kind of unique. So typically when you perform a discounted cash flow analysis, you need to project a growth rate to the future free cash flows. And to do so, you want to look at the historical data and the historical free cash flow for that company. But obviously AT&T has recently spun off Warren Media, meaning that their prior free cash flow is not going to be as relevant as it is now. But like I said, we do have the current projection. They projected for anywhere from the 14 to 16 billion range. For this scenario, I am projecting about 14.2 billion for the year and applying a growth rate of about 4% based off of analyst expectations, some research from myself, and industry expectations. So I'm applying this 4% growth rate to the future free cash flows of the company and applying it to the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of these future free cash flows and added them together right here. I added the company's cash and subtracted out their total debt to find their equity value. I then divided by the number of shares outstanding to come to a discounted cash flow price per share of $21.70. So again, we are slightly above that current trading price. Now let's go ahead and jump over to our multiples valuation. And the idea behind our multiples valuation is we should be able to value a company based off how the market is valuing companies that are similar in structure using a price to earnings multiple. Now again, I think this is kind of a unique situation because there are really not many companies that are pretty similar to AT&T. Obviously, the best comparison we have is Verizon. So instead of actually performing a complete multiples valuation, we're just going to take a look at their price to earnings multiple. So Verizon's currently trading at a price to earnings multiple of 9.27. If we jump back over to our stock screener, scroll down right here, we can see AT&T's trading at a price to earnings of about 8 right here. So since we don't have enough comparables to really complete a full multiples valuation, I still think it's worth noting that they are trading at a slightly lower price to earnings multiple than Verizon. But let's go ahead and remove this intrinsic value calculation here because we don't want it showing up in our output tab. Now we're going to look at our last valuation, which is going to be our dividend discount model. And again, this is going to be slightly different due to the spinoff of Warren Media. So obviously AT&T has recently cut their dividend when they spun off Warren Media, but because of this, we can't use the historical dividend payouts to project the future dividend growth rate. But what we do know is how much they're currently paying out in dividends for each quarter. So I can use this number to project out how much they pay out a year, but now I need to use it to project how much we expect them to continue to increase the amount they pay in dividends. And again, this is a more mature company, a higher payout ratio. It is a safe dividend at its current payout right now, but I am projecting a slightly lower growth rate of about 3%. After applying a discount rate of 8.5%, we can see we come to a dividend discount model price per share of $20.82. But let's go ahead and jump over to our output tab now. And here on our output tab, we have all 4 of our valuations. Obviously, we decided not to use the multiples valuation, but we have Grams at $25.50, discounted cash flow at 21.7, and dividend discount model at 20.8. When we average all 3 of these together, we come to an intrinsic value of $22.72 per share. Now, when we look at the current price of AT&T, it's trading at about $18.92, but I am a value dividend investor, so I do always want to apply a margin of safety. So let's say that I'm a little bit more aggressive with my margin of safety and I want to apply a 20%. We can see based off of this, our acceptable buy price for AT&T is $18.18. So it's still not quite within our buy range. If we wanted to apply a 30% margin of safety, we can see our acceptable buy price would be about $15.90. So AT&T would still need to drop quite a bit for it to be considered a buy. As for me, I do love the high yield that it's currently providing. Obviously, not quite as high as it recently was before the spinoff, but almost at 6% right now. This payout ratio has not been updated, so it's not correct. I do think it's a fairly safe payout right now, but I did add a few shares of AT&T to my long-term dividend growth portfolio. I don't think they'll increase the amount they pay out in dividends at a very high rate, but at that 6% range, I do think it's attractive, and I do think over the long term, this stock price will continue to increase slightly over time. But go ahead and let me know what you think of this company, what you thought of the earnings report. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.